Yeah, we're going to add another voice to the conversation. Roger Ferguson, well known to our viewers, former vice chairman of the Federal Reserve. He's also the former CEO of TIAA and a CNBC contributor. Roger, it's great to see you. Good morning.
Good morning. Nice to be here.
The economy has been something of a Rorschach test for, looking at the same sets of data and looking at the same market performances, but having different interpretations. You have one school of thought. We just heard from Mohamed El-Erian. The Fed needs to hike faster and steeper until essentially there's more pain in the stock market. And then you have others like, Chair Powell and Larry Summers and others who are suggesting that, hey, maybe we need to slow it down because the economy is too murky. What school of thought are you in?
I think I'm more in the latter school of thought. And the reason is that the Fed has moved very, very quickly, historically rapid pace. They've gotten rates into what I think they believe to be restrictive territory. They are starting to see the economy slowing. Already goods inflation is way down. And so I think the Fed at this stage is feeling much more comfortable than it was, back in the summer, and therefore more likely to move at a gradual 25 basis point pace for the next 2, maybe 3 meetings, just to see, the result of their handiwork to date.
So how many meetings do you think it will take for the Fed funds rate to reach that plateau, for the Fed to be able to look back and say, OK, what we've done is now priced into the economy, and we can sit back and see how it plays out?
I think the Fed's likely to go 25 basis points at least at the next 2 meetings, which is this one and the one in March, and possibly May, depending on how the incoming data play out. And I think that will take them to a so-called terminal rate of slightly above 5%. That's a little higher than the market expects, but I think that's where they're likely to end up.
Hey, Roger, how much concern do you have that the Fed is all bunched up in terms of their outlook at sort of right around that 5%, and there is not a whole lot of differences? I can't really tell who's a hawk and who's a dove on this committee right now. Is it possible they're making a similar mistake to the one they made when they all kind of got behind the transitory in the transitory camp?
It's possible, Steve. I think the difference right now is they all agree they've gotten into restrictive territory, which is very important. And you heard from Chris Waller. I think the differences are now relatively nuanced, 25 basis points more or less between them and the market. And that's not a bad place to be. I think the biggest disagreement between the Fed and the market is a consensus view in the Fed that you're implying about, the fact that they expect to not cut at all in 23 and the market expects to cut. And there's, I think, a little bit of risk that, in fact, there's a groupthink at the Fed that says, no way are we cutting. And as the incoming data show up, it may be appropriate to at least have that on the table. I don't think that's likely to be on the table. And I think that's where some of the risk might actually start to emerge.
Having been in the room, Roger, does it matter for the Fed to just sort of say, you know what, we had this wrong. We're gonna do it wouldn't be quite an about face, but say, hey, market is right. We need to cut again. Is that a big deal for the Federal Reserve? Does that undermine the institutional credibility?
I think the thing that supports institutional credibility more than anything else is being right. And so, if at the end of the day they say, well, our plans back at the beginning of 23 to not cut proved not to be the better judgment, so let's go on and bite the bullet and do the right thing, that is how credibility emerges. Getting there late is never that attractive, but better late than never, as they say. I still, however, think we need to wait and see. So while the market expects a cut, I am not yet in that camp. I think inflation, the market may be underestimating how tight labor markets will remain. And I think that's another disagreement between the market and the Fed. The Fed is looking at labor markets that remain tight, wage pressures that are probably still inconsistent with their ultimate 2% goal. And I think the market may be downplaying, that difference as well.